With U.S. interest rates still stuck at historic lows, getting income from corporate dividends has become a priority for many investors. Why are dividends so important, and how can you avoid dividend investing mistakes made by the masses? We're joined today by Lance McGray, head of ETFs at Advisors Asset Management. The firm manages a bevy of investment solutions from mutual funds to unit investment trusts and ETFs. Lance, welcome to the program.
Thanks a lot for having me, Julie.
As you know, dividends play a crucial role to an investor's performance results. Almost 80% of the S&P 500 total return over the past 50 years is attributable to compounding dividends alone. Do you think investors, maybe because of being short-sighted or impatient, sometimes overlook the long-term power of dividends?
I think that in these certain environments, like we're experiencing right now, I think that is a safe assumption to make. For nearly a decade, growth stocks have actually led the market further north. And, the importance of dividends over the long term for capital appreciation and also income generation has really gone by the wayside because of the outperformance of growth stocks. To your point, if you look at pretty much over the last 100 years, a large portion of long-term capital appreciation within the equity market has really been attributed to not only dividends, but the reinvestment of those dividends over the long haul. So dividend investments, dividend strategies, dividend ETFs are extremely important, as I mentioned, not only in these low rate environments, but also for investors that are looking for long-term capital appreciation. On this front, I'd also like to mention that when we talk about dividend strategies, it's just not a one-size-fits-all type of strategy. It's really important to look under the hood and see what you're getting with dividends, because in reality, there's really two large buckets. When somebody is investing in dividends, they're generally doing one of two things. They're, number one, either investing in a portfolio of high dividend-paying stocks, which are looking to maximize your dividend yield, or on the flip side, they're really worried about dividend sustainability and the ability of that company to grow and maintain that dividend over time. Now, these two strategies are completely different, even though they focus on dividends. One is looking to produce high yield. The other one is looking to produce that slow, stable income growth over time, which generally comes with some sort of quality association to it. So when you're looking at dividend products, it's really important to look under the hood and see what you're investing in. And at Advisors Asset Management, what we are trying to do with our high dividend value approach is try to mix the two together. The two strategies don't have to be mutually exclusive, and you can pair high dividend paying stocks with companies that are producing high cash flow and have a likelihood of maintaining and growing those dividends in the future.
Some income investors have bad memories and they forget about the danger of relying on single stocks as a primary source for dividend income. What can help income investors to overcome the pitfalls that come with a single stock approach to dividend investing?
And it really comes down to diversification. And even before we get into the actual strategy and how we try to incorporate this, how we incorporate diversification into the portfolio, let's talk about the ETF wrapper. That's exactly what it's there for, right? ETFs do exactly that for the masses, and that's allow diversification into a portfolio or into somebody's holdings. For example, if somebody has $100 to invest in their IRA or 401k, they're not going to, for the most part, it wouldn't be a welcomed move to go out and buy a single name equity. There's too much concentration risk in that equity or that investment security, whether you're looking at capital appreciation or dividend income. What is better to do for most investors is to invest in a fund, invest in an ETF where you have the ability to spend $50, $100, $25 or even less in some instances to buy an ETF of a sliver of hundreds of securities. And it really comes down to diversification. One of the worst things that you can do from a dividend investing standpoint is to hold securities or hold stock of companies that are going to cut or have cut their dividend. That can take a massive hit to one's capital appreciation over time. And one of the things to do is invest in a potential ETF or fund, which helps diversify that risk across a number of holdings and not specifically into one individual stock.
Industry sector diversification is another important element behind a successful approach to dividend investing. And although certain industries like consumer discretionary and energy have seen sharp dividend cuts or suspensions, the AAM S&P 500 High Dividend Value ETF, the ticker symbol SPDV, holds exposure to a broad swath of different sectors. Can you tell us more?
Absolutely. Our high dividend value suite, which we launched nearly 3 years ago, as you mentioned, our high dividend value U.S. large cap equity product, SPDV, it's a product that was created with over 15 years of sort of research and track record. As you alluded to in the intro, at Advisors Asset Management, we have a whole host of products, our unit investment trusts, our SMAs, our mutual funds. The one thing that we really focus in on is income. Not only on the fixed income side, but when it comes to equity, we also have many offerings on the dividend income side. And one thing that we've done over the year is essentially, actually over the last few years when we were creating this product, was to identify some of the shortfalls that we had not only internally with our existing products, but also look at the landscape out there of dividend products. What were some of the shortfalls that these other equity income portfolios had? Whether it was high yield or just dividend sustainability, or whether it was semi-annual or quarterly distributions. We've sort of gone through the list and we've sort of identified how we can tweak our strategy to better suit those investors. As I mentioned, we blend the two strategies of high dividend yield and high free cash flow yield or dividend sustainability into one metric. So we're combining the best of those both worlds. We're obviously producing a dividend yield that historically has been twice that of the S&P 500, but at the same time, we're trying to minimize our exposure to dividend cutters by focusing on cash flow. In terms of the diversification, that was another major aspect of our products versus our competition. In many other dividend products, especially dividend ETFs, many of them will be focused in high-yielding sectors like utilities as they reach for yield. And as we touched upon with diversification, it's in our best interest as an ETF sponsor to offer and provide a product that's different, that offers the diversification and can potentially help investors mitigate their risk associated with single stock and single industry or single sector diversification. So in doing that, what we've done is we've actually created a system, a rules-based methodology where we select 5 securities from each of the 11 gig sectors. We equal weight the stocks, and that allows us to have exposure not only to utilities, which tends to be, a major tends to be one of the sectors with the higher yields, but it also provides us sector exposure across all 11 gig sectors. So if one sector does fall out of favor, we have 10 other ones to rely on. So that is another major talking point, a major differentiator between our high dividend value ETFs and the competition out there.
One final thing before you take off. You've been in the ETF industry for a long time. You've overseen many successful product launches, and you've seen your fair share of criticism of ETFs, their impact on the market, and their product structure. On the other hand, the Federal Reserve's usage of ETFs to support the U.S. bond market via a multi-trillion package is a huge endorsement of ETFs. How do you see it?
That is a very interesting point, and it's something that I've been watching, obviously, for the last few weeks now. And it seems like it wasn't too long ago where the ETF wrapper was being scrutinized as being, the wrapper that's going to jeopardize the foundation of the financial market here in the U.S. And ironically, a few years later, now the Fed is relying on ETFs to provide that liquidity and stable the market that's really in a challenging time right now. So, looking back on where we've come over the last 10, 15, even 20 years as an ETF industry, it really does speak volumes and does endorse the wrapper, not only the wrapper itself, not only the strategy or the ETF sponsors, but more importantly, it really speaks to the ETF ecosystem and how well it is constructed and how much confidence, say the Fed has in the actual ETF to do what they're potentially doing or what they have started to do in the last, week or so with providing liquidity and some sort of stabilizing into the financial markets.
Lance, we appreciate your insights and having you drop by today. Again, you just heard from Lance McGray, head of ETFs at Advisor Asset Management. I'm Julie Gaertner with ETFguide TV. Thanks for watching.